Joining me now is Wilson Asset Management founder Geoff Wilson. Geoff, welcome to the show. And a looming political issue is Labor's intention to tax unrealised capital gains. Just to start with for our audience, can you please explain the nature or the principle of what Labor's intending to do here?
Yeah, look, thanks, Carolyn. Thanks for your time. The Labor government is bringing in, what they plan on bringing in, it just needs to go through the Senate, a policy whereby superannuation funds that have more than $3 million in will pay an additional tax of 15%. So it's an all-up tax of about 30% over that $3 million mark, which I think no people that have money in super are concerned about. Where the concern is, for some reason, the government is talking about taxing unrealised gains. So the theoretical change in the value of your investments that aren't turned into cash and aren't realised. And this is, it's really bad tax policy. Also, what they're saying is that they're not going to index the $3 million cap, so which means that eventually everyone in Australia with inflation will be paying this tax. So they're the parts. All I need to do is index it and remove the tax on unrealised gains, which sort of are paper profits or theoretical profits, which may end up turning into losses.
Yeah, and obviously is a huge cash flow issue. But yesterday, Treasurer Jim Chalmers, he tried to placate fears. Here's what he had to say.
We've made it clear that these changes are relatively modest, but they're important in the context of the budget, and defined benefit schemes have been appropriately recognised as part of our effort.
Whenever a politician says something is modest, it eventually, inevitably, my ears prick up. What are the unintended consequences of this policy on the superannuation industry?
They are significant. Jim Chalmers and also Anthony Albanese, they say the tax only impacts a very small percentage of the Australian population, 0.5%, and that is correct. The negative part, or the illogical part, or the reason why there are those significant unintended consequences, is because it will impact the behaviour of the whole superannuation industry, and that's really a major supporter of corporate Australia. So $4.2 trillion, it's going to impact how that $4.2 trillion how it behaves. So why would you take risk? So there's $1.1 trillion in self-managed super funds. They have been big supporters of startups, small companies in Australia, and now if they're going to be taxed on a pretend profit that may never eventuate, why are you going to take the risk? So there are significant unintended consequences. We estimate that close to $150 billion will come out of the superannuation sector and go into the property sector, because there's no tax on your own home, whether it's your home or your children's home or your grandchildren's home. I mean, we're already seeing it. I think front page of the Financial Review today, they're saying self-managed super funds panic money coming out before June 30. Well, actually, you've got till June 30 next year to get the money out. So to me, it's unfortunately this tax it will backfire. It's not a good tax and a good idea.
And is that because the government, I mean, look, in principle, I find the principle offensive in itself, but has the government just not consulted broadly enough or understood the actual human behaviours that are essentially going to occur to be able to avoid paying tax on unrealised capital gains?
Well, that could be the case, what's probably more concerning. I know front page of the Australian the other day, Matthew Cranston wrote an article, and it said that Treasury's been trying to bring in the tax on unrealised gains for the last 15 years. So maybe maybe this is a way of the thin edge of the wedge, getting them in. I think what the government doesn't understand, or maybe it hasn't fully modelled, or it's a bigger conspiracy theory. They want to put it on other assets, family homes, etc. Is globally this has failed. More recently, Norway brought in a sort of a tax for the very high income earners, an unrealised gains tax, and $56 billion left Norway. Instead of the money, they're only expecting to raise about $150 million from this new tax, and instead they went negative, close to $500 million. So what they don't realise is everyone changes their behaviour, and it's clear already that people are going to start changing their behaviour.
And you mentioned investment in startup, and you mentioned the potential for that extra liquidity or that extra demand to go into the housing market. But what other broader industry and investment consequences either have we seen elsewhere, or would we suspect under a policy change like this?
Well, I mean, just another example, in the UK, in terms of the unintended consequences. In the UK, they increased the tax on capital gains by 20-odd%, and instead of the tax take increasing by 20%, it actually fell by 10%. So, but probably one of the biggest ones. It's really, everyone is now questioning superannuation. Is superannuation this pot of gold that every government tries to take money out of? People that are older, they can take their money out of super and there's no consequences. Younger people are locked in there. And I'm aware of a number of people that have said, hey, look, we're not going to, we're going to try to put as little as we can into super going forward. So it really, that pool of capital that's helped, support growing small businesses in Australia, that Paul Keating is very proud of. I think he hasn't come out publicly, but privately he's come out and said that he thinks it's just really bad policy.
Now, just one last thing before we go. ASIC has launched prosecution proceedings against Macquarie, and the allegations there relate to the reporting of short selling. Obviously, it's subject to a legal process and they're just allegations at the moment, but what do you make of that particular move?
Well, in terms of, does it make Macquarie a less attractive investment? Will it have a negative impact on their earnings? The answer is probably no from an investment perspective. In terms of, is it the fact that they've let this happen? Is that poor corporate behaviour? The answer is yes. They obviously haven't communicated clearly with the regulator, and they're going to suffer the consequences. There will be some financial pain. It'll be a one-off financial pain. Maybe this is a function of growing too quickly and not having the right systems in place. That's what it appears like to me. I mean, obviously, this is a big wake-up call for them, to get their house 100% in order.
Yeah, I'd say it absolutely would be. Geoff Wilson, thank you so much for your time and your insight.